Hey everybody, how is it going today? Well, in this video, I'm going to be doing my monthly M1 finance account update for the month of December. And there is one stock in particular that has been pulling back substantially lately, but I think it is setting up for a very nice buying opportunity. So I'm going to go over that. Now, if you're new to my channel, I like to find short-term and long-term trading and investing opportunities in typically lower-priced stocks. I like to find undervalued stocks with high growth potential and talk about all other things finance-related as well. If that's something that interests you, please consider subscribing so you don't miss any future trading or investing ideas. But please remember, I am not a financial advisor, so please do all of your own research before buying any of these stocks. Now, last month's video I put out on my M1 Finance account for the month of November that I uploaded on November 28th. My M1 Finance account had a money-weighted return of a positive 102%, and the account value was approximately $14,104, and I had earned a total of $112.54 year-to-date in dividends. All right, well, here is the current value of my M1 Finance account. We're right on the home page right now, and we can see the value has grown to $16,761.34. The money-weighted return has grown to 123.2%, and my earned dividends has increased to $134.71. And this is intraday, so these numbers are going to fluctuate just a little bit. But if we go down and look at the portfolio, we can see that Tesla, of course, is still the #1 holding, and it's up over 1,000%. And so, of course, I am very happy with that one. But the other one that is quickly growing in the account is CRISPR Therapeutics. CRISPR has grown to the second highest returning stock in the portfolio, overtaking Square. And when CRISPR was pulling back, I was adding just a little bit more several months ago. And of course, CRISPR has exploded lately. So that is resulting in a very nice gain for my M1 Finance account. I am also holding some CRISPR in my IRA, and I have an average cost of about $37 on that one. So that is up substantially. I have actually been eyeballing wanting to sell some of it just because it has gone up so far, but I haven't pulled the trigger on selling any just yet, but I'm watching it closely. But I won't be selling any in the M1 account. This is going to be a long-term hold, and I'm just going to accumulate every week that I can in my M1 account. But if we scroll down a little bit, we can see that Disney, of course, is having a fantastic rebound off the pandemic lows. So this one has been a very nice gainer in my account. Apple, of course, is rock solid. Skyworks Solutions has been rock solid as well, up 71% in the portfolio. And I expect Skyworks Solutions to be a big player in the 5G growth. So I have no plans on getting rid of Skyworks Solution anytime soon. If I start scrolling down a little lower, we can start seeing some of my real estate investment trusts that pay me decent dividends. We have Old Realty Corp, that is up only 4.9%, but that's okay. I'm pretty much holding that one just for the dividends. We have Peak that is up 15.8%, that also pays a very nice dividend. Simon Property Group, LTC, those are also real estate investment trusts that pay me a very decent dividend. And then we start getting down into Verizon and AT&T. They should be big players in the 5G growth, and they also pay very nice dividends. AT&T is right around, I think, just under 7% at the moment. And AT&T is having a hard time getting going. If you follow AT&T at all, AT&T had a nice move up above $30 a share, but that was quickly met with a sell-off. So AT&T, for whatever reason, can't seem to get above $30 a share. Now, I personally think AT&T is probably going to be at least a double in the next 5 years. So I am very happy to be accumulating AT&T at these levels and earning that nice, almost 7% dividend while I wait. Now, Verizon, I think, is paying about a 4.5% dividend. So I'm very happy to be holding on to Verizon. If we scroll down a little bit further, we can see Grow Generation has been a very fantastic stock in the portfolio. I wish I would have had more than 2% into that one, but that is my diversification into the MJ space. Now, my ARK K fund is doing very well, of course, up 252%. And if we scroll down all the way to the end, we can see some of my lower positions, only my 1%. These are um, basically just adding a little bit of stability to the portfolio for the long term. They represent only 1%. I have some treasuries. I have a Vanguard Total International Bond Fund and the Vanguard High Dividend Yield ETF. I probably should be raising that one up just a little bit, but I'm not going to do that until the market gets a little bit toppier. But one position change that I am considering making is getting rid of Waste Management. Waste Management is a very good company. You know, they have a very nice moat. It's hard to break into that business, and it's only 2% of the portfolio, but it is just a slow mover. I think I can do a lot better with another dividend stock. I think Waste Management's only paying about a 1.5% dividend at the moment, and the stock, you know, it's not a fast mover. It was added basically just to add some stability to the portfolio while accumulating a dividend along the way. But I think I could do better with some other companies and get a more attractive yield. So probably in the next video, I will have gotten rid of Waste Management. I haven't got rid of it at the moment. And I don't know if I'm going to add anything. I'm probably just going to take that money and redistribute it to the other companies. One other company that I am keeping a close eye on is Illumina. The more I think about it, the more I'm thinking I probably should get rid of this one in the coming months and redistribute that money elsewhere, because this account is rather over diversified. So I could probably get rid of a couple other companies and just diversify into the portfolio. But let me go up to the top and let's look at the account value, or let's look at the return. Let me see if I can. Oh, yeah, let me get it to 1 month. I just want to show you how well these stocks have performed in the last 30 days. Like I was saying before, CRISPR has had a huge move, and they are my top performer for the month. For the month, it is up over 41%. So just a monstrous gain in CRISPR Therapeutics. And my second biggest gainer, surprisingly, is Baidu. You know, another Chinese company. I'm only holding Baidu and Alibaba, but Baidu has done very well since its recent pullback. And of course, the third best performer is Disney. Disney has come out with some great news in the last 30 days. You know, they're talking about a lot of the content they're going to be adding to their Disney Plus service, and a lot of analysts are very bullish on that. And of course, when all the theme parks and everything else they have going on with their cruises start opening up to full capacity, I think Disney is going to be a super fast grower. You know, my fourth best grower for the month was the ARK K fund. I mean, that fund is all the ARK funds are basically just beasts, and I probably should be adding the ARK Q to this. That is one that I am considering adding when I get rid of Illumina. Because that space is very difficult to understand, at least for me. So I'm thinking in the genomic space, I probably should just leave it up to ARK Invest to make those decisions for me, because they're very tough to wrap your mind around. So I think if I get rid of Illumina and maybe add the ARK Q fund and start accumulating that, that would be a very nice position to have in my M1 Finance account going forward. But let's scroll down to the bottom, to the worst performers. Now, if we scroll down all the way to the bottom, my worst performer for the month was Alibaba, which is down on antitrust news. I'm going to get into that later, but I personally think that this is a fantastic buying opportunity in Alibaba. So I don't mind that it's pulling back right now, and actually I'm going to probably raise this percentage higher and start accumulating more of Alibaba's now that it's at these levels. My second worst performing stock is Dominion Energy, and this one is a bit of a head scratcher. I got my eyes on this one. It is performing like there is going to be some bad news coming out, so I'm a little worried about that position. It's not a very big one in here. They pay a very decent yield, so I'm not going to get rid of them just yet. But like I said, I got a weird feeling they're going to come out with some bad news, and depending on that news, I'll probably make the decision when that comes out, if it does come out, and decide whether I want to accumulate more of it or just keep it where it is. And Verizon, AT&T, man, they're having a hard time getting going for whatever reason. But that's fine with me because I think they're going to be good growers in this 5G boom, and I am very happy to be accumulating them at these levels because they do pay a very nice dividend. So the more shares I have, the more dividends I am going to get. So I have no problem with these sitting where they are. And we look back up here to a waste management. We can see that it's one of my worst performing stocks in my account. It's not the fact that I have any remorse for putting them in there, but it's just too slow of a mover and the yield isn't that great. So I think I'm probably going to dump that one and distribute that elsewhere. Now, before I jump on to Alibaba, I did want to let you know the result of the M1 borrow. I used the M1 borrow feature last month just to see how it worked. I borrowed $500 from M1 and bought some stock with it, and I must say I really like this feature. It was super easy, just a couple of clicks, and I borrowed money to buy some more stock, but I could have borrowed money and sent it right to my bank account because that's also part of the feature, and it's just, I don't know, I just really liked it. I'm really happy that I have this M1 Finance account, and having that feature makes it even that much better. You have that much more flexibility. But what all I did was take $500 and I put it in my queue to buy more stock, and I actually had a $100 um, transfer that happens every Monday. So I actually bought $600 worth of stock that day, and that was on November 30th. So on December 4th, it took out 15 cents in interest. And on December 7th, I actually sent $500 from my checking account to my M1 just to pay that loan off. I'm not a big fan of paying interest. I am a fan of collecting it, but just not paying it. But I just sent that 500 in to satisfy the balance on that loan because I just wanted to try this out. And I paid 15 cents interest, for so what is that, about 2 weeks? Well, maybe a little bit, just a little bit longer than a week. But 15 cents interest is nothing. If you ever get into a pinch and you have an M1 finance account, you could send money to your checking account, and if you only need it for a couple of days, the interest is going to be nothing. So this is just a fantastic feature. Gives you that much more flexibility into your finances, and I didn't have to sell any stock for it, so it didn't create a taxable event. It was just borrowing money at 3.5%, and like I said, the interest is basically nothing. So I personally love this account so far, and I look forward to building it up. But I wanted to show you guys the result of that M1 borrow before I got out of here. Now, in this recent article, it says on Christmas Eve, shares of Alibaba took a nosedive after the Chinese government said it would open up an antitrust investigation against them. The news comes just weeks after Beijing blocked the IPO of Ant Group, Alibaba's fintech subsidiary, a further sign that the ruling Chinese Communist Party, or the CCP, is seeking to thwart Alibaba's founder Jack Ma's power. Now, in a shortened session, Alibaba stock closed down 13.4%, wiping out approximately $100 billion from its market cap. The article also says China's antitrust body, the State Administration of Market Regulation, said it had opened an investigation into Alibaba for monopolistic behavior, citing practices like preventing its vendors from selling on other platforms. Jack Ma has been under regulatory spotlight since October when he made several remarks mocking the CCP for being too risk-adverse and criticizing the financial regulatory system in other ways. Now, the Chinese state-run media responded with its own attack on Ma shortly after that, and then it blocked the Ant Financial IPO, which was set to be the biggest ever in the world. Now, in my opinion, I think Jack Ma is going to realize he's gotten a little too big for his britches, and they're going to come to an agreement with Jack Ma hopefully backing down a bit, so eventually the Ant IPO can come out and they get back to business as usual. Now, the CCP can be overbearing, but I think they have a national interest in keeping Alibaba a global powerhouse. Now, the article also points out the fact that Alibaba now trades at a price-to-earnings ratio of approximately 24, which is significantly less than the entire S&P 500, even though the company is just as dominant as any of the other American tech giants, with strong positions in e-commerce, cloud computing, and digital payments, among other areas. Alibaba also posted a 30% revenue growth in its most recent quarter. Now, if we jump over to Seeking Alpha, we can see just how dominant Alibaba has been. And if we look at their top line revenue growth, we can see in March of 2016 it came in at 15.7 billion, and by March of 2020 it has risen all the way up to 72 billion. And if we look at their trailing 12 months, we can see that that came in at over 86 billion. And if we go down to their gross profit, we can see how fast that's growing because in March of 2016 that came in at 10.3 billion, and by March of 2020 that more than tripled all the way up to 32.5 billion, and their trailing 12 months has increased all the way to over 37 billion. Now you don't get a chance to buy big tech companies that are growing this fast on sale very often. So I personally think that this is a fantastic buying opportunity. All right, everybody, so let's head to the chart. This is the current daily chart of Alibaba Group, ticker symbol BABA. If I zoom in just a little bit, we can see the huge down day that it had on Christmas Eve, and that came on absolutely huge volume, big institutional selling. There was over 141 million shares traded that day. Now, as of today, volume is still up big because it gapped down in the morning, but it has since turned around, and the candle is actually green at the moment, but it is forming an inside day, which actually is a bullish sign. So it looks like it's consolidating a little bit at this level. I would actually like for it to pull back a little bit more. I am going to raise my percentage in my M1 account on my Alibaba position to take advantage of this deep pullback. If I back the chart out a little bit, we can see exactly how deep it is. But if it can pull back just a little bit farther, I am going to be very interested in adding some to my IRA. You don't get many opportunities to add to these big tech companies that are growing this fast. And if it can pull down to this trend line just above $200 a share, I'm going to start a position in my IRA. And if it falls further, I'm going to add to it. I think this selling is overdone, so I'm planning on taking advantage of it. I'm just hoping that I'm not getting too greedy, hoping it falls just a little bit more. But because the momentum has been so strong, I can see it certainly falling to this trend line and even breaking that trend line and going a little bit lower. And if that happens, I'm probably just going to add to my position more, and I plan on holding this for the long term. I personally think that this is a fantastic buying opportunity. You know, if we go back to the weekly chart, we can see how far it has come. In 2016, it traded all the way down to around $60 a share, and right now it is up over 200. And before this pullback, it was actually trading well above $300 a share. And I think Alibaba is going to be a very, very fast growing company for at least the next 5 to 10 years. I know some people don't like to buy Chinese companies, but China has a super large economy, and they're going to be growing very fast for years to come. So I definitely want to be a part of one of their bigger tech companies. Man, and if we actually go back to 2015 and look to the advancement into 2017, we can see that this was a very nice cup and handle pattern on the weekly chart. You know, I wish I would have seen that because that resulted in a very nice move to the upside. But I could certainly see Alibaba in the next 3 or 4 years being well over $500 a share. So I think this is a great time to add Alibaba to my long-term portfolio. And hopefully it can trade all the way down to $200 a share, or even break that trend line, because I think it's a fantastic buy even under $200 a share. So hopefully it pulls back so I can grab some for my IRA, but that's my current thoughts on Alibaba at the moment. All right, right now I'm going to go over some of the best performing and worst performing stocks in my M1 account and what my thoughts are on them. The first one I'm going to go over is the best performer. It is CRISPR Therapeutics, ticker symbol CRSP. And as we can see, CRISPR has went on a massive run in these last couple of months. If I zoom in a little bit, though, the thing that I'm concerned about is it looks like it could be selling off a little bit. Looks like it could be under distribution. We can see these topping tails that it's having. It did have a move above it, but it seems like shares are just churning at this level. Today it gapped up, but it sold off immediately. The day before, it went from the high of the day all the way down to the low of the day. And the 2 days before, it looks like there was also selling as well. And in my um, email account, I get the buy and sells of ARC, and ARC is a big holder of CRISPR, but lately they have been a seller. I'm assuming they are just taking advantage of this big move up, and I think that's what I want to do. I think CRISPR and some of these other stocks in this industry are due for a sharp pullback, so I'm actually looking for my exit, and hopefully I will be able to re-enter at a lower level. If we look at some other stocks in this industry, we can see Editas has went on a massive run. Um, it's been on just a tear because they had some favorable results in some of their trials. And if we look at the other one in their industry, Intelia, Intelli has been on a massive run as well in these last few months. So I think these stocks are probably due for a pullback. It is a very exciting sector to be in. I am not going to be selling out of my M1 account that I'm holding for the long term, but I am looking to get out of that position in my IRA just so I can re-enter at a lower level. I'm not bearish on the company at all. I just think it's been on a huge run. So I think they are due for a pullback. Now, another one of my better performing stocks is Baidu. And if we go back a little bit, Baidu actually pulled back quite a bit in March, but has been on a fantastic run. When the stock was pulling back from 150 down to the 50 SMA, I noticed I was accumulating a little bit more in my M1 Finance account, and of course, Baidu has had that screaming run ever since. So that's why it is one of my better performing stocks in my M1 Finance account. The other one I want to touch base on was Disney. And Disney has had a massive run in these last couple of months, and it looks like there is no slowing down. So I am happy that I was accumulating a lot of Disney when it was trading around $110 or so. But I think Disney has a very bright future, and I would actually like for it to pull back a little bit so I can accumulate more at a lower level. But it looks like investors are very excited about Disney because this thing is just super strong and there's no signs of pulling back. Now, let me get to some of the worst performing stocks in there. First one I'm going to talk about is Dominion. This sell off in Dominion has been, I don't know, it's been kind of a head scratcher because there hasn't been any real terrible news coming out of Dominion, so I don't understand why it's selling off so much. And it just looks super weak. So I have got a close eye on Dominion, and it looks like it is just destined to break this support level that goes all the way back to July and probably a little bit further back as well. But I'm expecting this one to crash through, $73 a share like any day now. And who knows how low it's going to drop. Hopefully, the drop isn't too bad and it's not on too bad a volume. But I don't know. I got the feeling like some bad news is going to be coming out of Dominion. So I've got a sharp eye on that one. Hopefully, that doesn't happen. Hopefully, this is a bottom and it heads higher. But I don't know. I just got a bad feeling. Um, Another one I wanted to show you is, of course, the chart of AT&T. And AT&T looked like it had some momentum, jumped above that 8-period exponential moving average, broke above the 200 SMA. It looked like it was picking up some steam. And I thought for sure it was going to consolidate above this 8-period exponential moving average and be heading higher, but it is not. It is heading down again and is broken below $30 a share. Um, I don't know why, but for whatever reason, it just can't seem to stay above $30 a share. But I am going to continue to accumulate at these levels, so it really doesn't bother me too bad that it stays under 30. I am happy to continue to buy more, but I can certainly see this stock above $40 a share in the next 3 to 5 years because they have so many facets of their business that should be growing. You have your HBO Max, you have the 5G wave that's coming that they should benefit from. So I have no problem holding on to AT&T. And hopefully I can get some more. But last one I want to show you is Verizon, which was the third worst performer. Um, and it isn't down a lot, so I'm not worried about Verizon at all. And Verizon's not a fast mover up or down typically. If we go to the weekly chart, I mean, this thing just grinds around anywhere between like $45 and $60, ever since 2014. So now we have this resistance level at above just over $62 a share. Now, if it can get above that, I can certainly see Verizon going on a nice run. So hopefully eventually it does do that, but I'm happy to be accumulating it at this level because, like I said, they are paying about a 4.5% dividend. So I have no problem holding on to Verizon. All right, guys, that's all I have for you today, so I'm going to end the video right there. But if you have any other questions or comments about anything you saw in the video, please leave them down there in the comments section. I'll get back to you as soon as I can. Please like the video if you enjoyed it and subscribe to the channel if you haven't already. Thank you so much for watching my video all the way to the end, and until next time, take care, everybody.